Hello and welcome back to Vitsik here. It's been a while since we discussed some technical information. So in this video, I will be discussing options Greeks. Now, options trading is something that I find very overwhelming. So time and again, I revisit this topic to learn and understand options and how they work. This video is an attempt to increase not just your knowledge base, but mine as well. So let's get started. Some time ago, I posted a video on options. You can find the link in the description below. But just for a quick refresher, without going into too many details, options are a derivative financial instrument where the buyer of the contract pays a premium for the right to maybe exercise, that is, buy or sell the underlying asset at a predetermined future date at the strike price, and the seller receives the premium and obliges by the buyer's wish. Now, there are two types of options, call and put options. When the buyer buys the right to exercise, it is called long call option. And when the seller sells the contract, it is called the short call option. When the buyer sells the contract or the right to exercise, it is called short call option. And when the seller buys the contract option, it is called the short put option. For more details, refer to the video on option. The link is in the description below. Now, moving on to option Greeks. The option Greeks are a set of 5 parameters that measure the sensitivity of an option's price to changes in various underlying factors. The 5 options Greeks are delta, gamma, vega, theta, and rho. Here's a simple analogy to help you understand the option Greeks. Imagine you're standing on a hill with a ball in your hand. Now, the ball represents the price of the option and the hill represents the price of the underlying asset. Delta tells you how much the ball will roll downhill for every step you take. Gamma tells you how much the ball will accelerate or decelerate as you roll down the hill. Vega tells you how much the ball will roll down if a gust of wind comes up. Theta tells you how much the ball will roll downhill over time, even if you don't take any steps. And rho tells you how much the ball will roll downhill if the angle of the hill changes. Let's understand each option Greek individually and then how they apply to option contracts. Delta measures the rate of change of premium based on the directional movement of underlying assets. In other words, how many points will the premium change for every 1 point change in underlier? For the call option, it varies between 0 and 1. And for the put option, it varies between -1 and 0. So if the delta is 0.4, it means that for every 1 point change in underlier, the premium will change by 0.4 or 40 points. Let's take a look at this graph to understand this in detail. X-axis is the spot price and Y-axis is the delta, ranging from 1 to -1. Delta for call is positive, meaning that the option price will increase as the underlying security price increases. The closer the call option is to be in the money, the higher the delta will be. Delta for put is negative, meaning that the option price will decrease as the underlying security price increases. The closer the put option is to be in the money, the lower the delta will be. Now, the delta can be used to estimate the profit or loss of an options position if the underlying security price changes. For example, if a trader buys a call option with a delta of 0.5, and the underlying security price increases by 1 point, the trader's option position will increase in value by 50 points. Calculate the probability of an option expiring in the money or ITM. The absolute value of delta can be used to estimate the probability of an option expiring in the money. For example, a call option with a delta of 0.5 has a 50% chance of expiring in the money. Delta is a dynamic measure and it can change over time as the underlying security price changes and as other factors such as time to expiration and implied volatility change. Delta is a powerful tool that can be used to manage risk and make informed trading decisions. Moving on to the next Greek, gamma. Gamma is used to measure the rate of change of delta itself to the change of underlying asset. Imagine a seesaw with a child sitting on one end and a bucket of water on the other end. The seesaw is in equilibrium, meaning that the weight of the child is balanced by the weight of the water. Now imagine that you pour some more water into the bucket. This will cause the seesaw to tip in the direction of the bucket. The more water you pour into the bucket, the more the seesaw will tip. Gamma can be thought of as the amount of water that needs to be added to the bucket to cause the seesaw to tip by a certain amount. In other words, gamma measures the sensitivity of the seesaw to changes in the weight of the bucket. Just as the seesaw is more sensitive to changes in the weight of the bucket, when it is closer to the equilibrium, options with high gamma are more sensitive to changes in the underlying security price when they are closer to being ATM or at the money. Gamma can be thought of as the acceleration of an option's delta. Just as acceleration is the rate of change of velocity, gamma is the rate of change of delta. Now, delta is a measure of how much an option's price will change for every 1 point change in the underlying security price. Gamma measures how much delta will change for every 1 point change in the underlying security price. For example, imagine a call option with a gamma of 0.5. This means that if the underlying security price increases by 1 point, the option's delta will increase by 0.5. In other words, options will become more sensitive to changes in the underlying security price. Gamma is highest for at-the-money options and decreases as the option moves further away from being ATM. This is because ATM options have the greatest potential to change in price if the underlying security price moves. Gamma can also be thought of as a leverage measure. Options with high gamma are more leveraged than options with low gamma. This means that small changes in the underlying security price can lead to large changes in the option price. For example, imagine two call options with the same strike price and expiration date. One option has a gamma of 0.5 and the other option has a gamma of 0.1. If the underlying security price increases by 1 point, the option price with gamma of 0.5 will increase in price by 5 points, and the options with a gamma of 0.1 will increase in price by 1 point. Now, gamma can be used to estimate the change in an option's delta if the underlying security price changes. For example, if a trader buys a call option with a gamma of 0.5 and the underlying security price increases by 1 point, the trader's option delta will increase by 0.5. It can be used to identify opportunities to profit from gamma scalping. Gamma scalping is a trading strategy that involves buying and selling options to profit from small changes in their delta values. It is also used to manage risk by hedging against gamma exposure. For example, a trader who is long on a large number of ATM call options may want to sell some out of the money or OTM call options to reduce their gamma exposure. Next comes Vega. Vega measures the rate of change of premium based on the change in implied volatility. Implied volatility is a measure of how much the market expects the underlying security price to fluctuate over the life of the option. Vega measures how much an option's price will change for every 1% change in implied volatility. Imagine a trampoline with a person standing on it. The trampoline is in equilibrium, meaning that the weight of the person is balanced by the tension in the trampoline. Now imagine that you pour some water on the trampoline. This will cause the trampoline to become more bouncy. The more water you pour on the trampoline, the more bouncy it will become. Vega can be thought of as the amount of water that needs to be poured on the trampoline to cause it to bounce by a certain amount. In other words, Vega measures the sensitivity of the trampoline to change in the amount of water in it. Just as the trampoline is more sensitive to changes in the amount of water on it when it is closer to equilibrium, options with high Vega are more sensitive to changes in implied volatility when they are closer to being OTM. Vega can be thought of as the sensitivity of an option's price to changes in implied volatility. Just as a person's skin is sensitive to changes in temperature, an option's price is sensitive to changes in implied volatility. For example, imagine a call option with a Vega of 0.5. This means that if implied volatility increases by 10%, the option price will increase by 5%. Vega is highest for OTM options and decreases as the option moves closer to being ITM. This is because OTM options have the greatest potential to change in price of if implied volatility changes. Vega can also be thought of as a leverage measure. Options with high Vega are more leveraged than options with low Vega. This means that small changes in implied volatility can lead to large changes in the option price. For example, imagine two call options with the same strike price and expiration date. One option has a Vega of 0.5 and the other option has a Vega of 0.1. If implied volatility increases by 10%, the option with a Vega of 0.5 will increase in price by 5%, and the option with a Vega of 0.1 will increase in price by 1%. Now, Vega can be used to estimate the change in an option's price if implied volatility changes. For example, if a trader buys a call option with a Vega of 0.5 and implied volatility increases by 10%, the trader's option position will increase in value by 0.5. Vega can also be used to identify opportunities to profit from Vega scalping. Vega scalping is a trading strategy that involves buying and selling of options to profit from small changes in their Vega values. It is also used to manage risk by hedging against Vega exposure. For example, a trader who is long on a large number of OTM call options may want to sell some ITM call options to reduce their Vega exposure. Moving on to Theta. Theta measures the impact on premium based on the time left for expiry. It measures the sensitivity of an option's price to the passage of time. Imagine a sandcastle on the beach. The sandcastle is constantly being eroded by the waves. The more time passes, the more waves erode the sandcastle. Theta can be thought of as the rate at which the sandcastle erodes. Theta is highest for ATM options and decreases as the options move further away from being ATM. This is because ATM options have the most time value, which is the amount of money that an option buyer is willing to pay for the right to exercise the options in the future. Just as the sandcastle is more likely to erode in a short amount of time than in a long amount of time, options with high theta are more likely to lose value in short amount of time than options with low theta. Theta is a negative number for both calls and puts. It is highest for ATM options and decreases as the option moves further away from being ATM. Theta is also highest when the time to expiration is shorter. It can be used to estimate the loss in an option's value due to time decay. For example, if a call option has a theta of negative 0.5 and 1 day passes, the option's price will be decreased by 0.5. It is also used to identify opportunities to profit from time decay. For example, a trader may want to sell an option that is nearing expiration, since the option price will decline due to time decay. It is used to manage risk by hedging against time decay. For example, a trader who is long on a large number of ATM options may want to buy back some of the options before expiration to reduce their exposure to time decay. The last of the option Greeks is rho. It measures the sensitivity of an option's price to changes in the risk-free interest rate. Imagine a savings account with a fixed interest rate. The more money you have in the savings account, the more interest you will earn. Rho can be thought of as the amount of interest that you will earn on your savings account if the interest rate changes. Rho is highest for long-term savings accounts and decreases as the time to expiration decreases. It is also highest for larger savings accounts and decreases as the saving account size decreases. Just as a larger savings account will earn more interest if the interest rate increases, options with huge rho will increase in value if the risk-free interest rate increases. Rho is a positive number for calls and a negative number for puts. It is highest for long-term options and decreases as the time to expiration decreases. It is also highest for ATM options and decreases as the options move further away from being ATM. Now, they can be used to estimate the change in an option's price due to the change in the risk-free interest rate. For example, if a call option has a rho of 0.5 and the risk-free interest rate increases by 1%, the option price will increase by 0.5%. It is also used to identify opportunities to profit from changes in the interest-free rate. For example, a trader may want to buy call options if they believe that the risk-free interest rate is going to increase. It is also used to manage risk by hedging against changes in the risk-free interest rate. For example, a trader who is long on a large number of call options may want to buy put options to hedge against the risk of an increase in the risk-free interest rate. So this was a brief introduction to option Greeks. Overwhelming, right? The topic is very vast and the information seems never-ending. But for this video, I chose to cover basics of the options Greeks. In the next video, we'll do a case study where we will apply these Greeks and see how they make a difference in options trading. Thank you for watching. If you gained something from this video, do give it a thumbs up and share it with your friends and family. And please do subscribe to our channel with Sikha for more knowledge from the world of finance. See you in the next one.